Across America at this very moment, something fundamentally wrong permeates daily existence. You don't require governmental statistics or financial market predictions to recognize it. Simply examine your latest supermarket receipt, your newest utility invoice, or the figure displayed on your credit card balance. For countless households, ordinary life has ceased being sustainable. It's evolved into a monthly calculation determining which obligations receive payment and which must be postponed. Throughout recent years, the narrative remained consistent. Inflation moderated officially, yet living expenses never declined correspondingly. Utility invoices escalated so dramatically that over 14 million households currently maintain overdue balances substantial enough to threaten service disconnection. Food expenses continue their upward trajectory. Gas and electricity extend budgets beyond breaking points. Essential services consume more resources than previously. Meanwhile, compensation barely advances, and savings vanish instantly upon appearing. Debt bridges the gap. Mortgage obligations sit at unprecedented peaks. Credit card debt has never reached larger magnitudes. Student loan delinquencies are climbing again, following years of suspension. Yet resilience appears different on financial statements than it manifests in kitchens at 11 p.m. when families determine which invoice can be delayed without forfeiting heat, water, or electricity. The picture crystallizes when we position these pressures adjacently and observe how utilities, debt, housing, wages, and daily necessities are all converging toward identical breaking points. For years, the public received assurances that inflation was diminishing, moderating, normalizing, yet the authentic experience of average Americans narrates a drastically different story. The official Consumer Price Index documented a year-over-year increase of roughly 3% in 2025, a figure frequently cited to suggest the worst has concluded. Yet food costs climbed by more than 3% during identical periods. Energy costs persisted in rising. Services, everything from childcare to home repairs, grew more expensive, not less. The macro data may have softened, but household budgets never received the message. This disparity between reported inflation and actual inflation is where everyday existence begins fracturing. When families claim groceries feel 20% more expensive, they're not exaggerating. They're responding to the cumulative burden of 3 consecutive years of escalating prices. When a gallon of milk costs slightly higher, when produce demands a bit more, when pantry staples creep upward month after month, it accumulates into a financial environment where paychecks stretch thinner and the margin for error vanishes. The identical narrative repeats with utilities. Even modest increases in electricity or gas rates translate into far larger pressure on households already breaking even. And since these essentials cannot be postponed or substituted, families feel the full impact immediately. Inflation on paper is a statistic. Inflation in real life is a squeeze. The moment when a family begins shifting from choosing what to buy to choosing what to sacrifice. And that shift establishes the stage for the deeper unraveling that follows. Among all the rising costs squeezing American households, utilities have become one of the most shocking sources of financial pressure. Electricity, water, gas, sewer, and basic energy services, once predictable monthly expenses, now behave like major debt obligations. According to national data, more than 14 million households entered 2025 with overdue utility balances significant enough to risk service interruption. The average arrears climbed to nearly $790, a level that would have been unthinkable a decade ago. This is not just a story of higher prices. It is a story of essential services breaking the household budget. The cost of electricity alone has risen faster than overall inflation for several years, driven by grid upgrades, fuel costs, climate extremes, and regional rate adjustments. Water systems across many states have increased fees to cover aging infrastructure, leaving families shocked when monthly bills resemble a car payment instead of a basic necessity. A growing number of Americans say they have received shut-off warnings or entered payment plans simply to keep the lights on. These are not isolated incidents. When millions of households simultaneously fall behind on utilities, it signals a structural shift, a moment when the basics of modern life become financially fragile. And the ripple effect is immediate. When utilities consume a disproportionate share of income, other bills fall behind. Medical payments, credit cards, rent, even groceries are pushed to the edge as families triage which essentials they can afford to keep. It is here, inside the rising cost of fundamental services, that the first cracks of everyday collapse become impossible to ignore. As everyday expenses rise faster than income, more Americans are relying on debt just to stay afloat. What once served as a financial cushion has become a lifeline, and now, for many, a liability spiraling out of control. By late 2025, household debt in the United States reached its highest level in history. Mortgage balances climbed past $13 trillion. Credit card debt exceeded $1.2 trillion, and student loan balances hovered around $1.6 trillion after repayments resumed. But the balances alone don't tell the full story. The real signal of strain appears in the delinquency data. Roughly 4.5% of all household debt is now somewhere in the delinquency cycle, from early missed payments to accounts over 90 days overdue. Student loans show the sharpest increase, with serious delinquencies rising to more than 9%, a rapid jump after years of temporary relief. Auto loan delinquencies have also ticked upward, reflecting the impact of rising car prices, higher insurance premiums, and costlier repairs. Credit card issuers, meanwhile, have reported billions of dollars in charged-off debt, a level not seen since the years following the global financial crisis. These write-offs reveal an uncomfortable truth. Households are not simply using credit to maintain their lifestyle. They are failing to keep up with the minimums. Debt becomes a trap when income cannot keep pace with the cost of essentials. Each missed payment tightens the pressure, reduces financial flexibility, and increases the odds of future hardship. And as more families fall behind, the picture becomes clear. The financial foundation of everyday American life is weakening from the inside out. For decades, housing was considered the anchor of financial stability, a place where families built equity, security, and long-term wealth. Today, that anchor feels increasingly out of reach. The shelter component of inflation has remained one of the strongest upward forces in the Consumer Price Index, reflecting the strain that both renters and homeowners now face. Renters across major cities continue to see monthly payments consume a record share of their income. Meanwhile, aspiring homeowners confront mortgage payments that have climbed dramatically due to elevated interest rates and historically high home prices. Even those who already own a home are not immune. Rising insurance premiums, higher property taxes, and maintenance costs inflated by labor and material shortages all add pressure to the monthly budget. A roof repair, a plumbing issue, or a new appliance, once manageable setbacks, now represent financial shocks capable of pushing families into debt. And the housing market itself is feeling the consequences. Home inspection companies report slow seasons unlike anything seen in decades. Mortgage officers describe workloads that have shrunk to a fraction of what they handled during the boom years. With affordability at its lowest point in a generation, prospective buyers remain on the sidelines, causing transaction volume to fall and leaving entire sectors of the housing industry struggling for oxygen. Affordability is not just a statistic, it is a measure of possibility. And when a home, the cornerstone of the American dream, becomes unattainable or unmanageable, it signals more than a housing problem. It reveals the growing fragility of everyday life. As housing, utilities, and basic living costs rise faster than wages, more Americans find themselves living one paycheck away from crisis. Recent surveys show that nearly 30% of lower-income households now operate with no financial buffer at all. And even middle-income families, traditionally more insulated, are increasingly vulnerable to unexpected expenses. In this environment, stability becomes fragile, and even minor disruptions carry outsized consequences. The paycheck-to-paycheck cycle is not merely a budgeting issue. It is a structural signal of economic stress. When a household must dedicate the majority of its income to rent, utilities, transportation, and groceries, the margin for savings disappears. And when savings disappear, so does resilience. A medical bill, a car repair, a rent increase, or a few days without work can tip a family into debt they may not recover from. Compounding the problem is the psychological weight of financial insecurity. Households caught in this cycle are not just struggling with numbers, they are navigating constant uncertainty. Decisions become narrower, priorities become survival-oriented, and long-term planning becomes nearly impossible. This is why so many families report feeling as though they are falling behind even when they are technically managing to pay their bills. In past generations, a steady job provided a reliable path to upward mobility. Today, that same job may barely cover the basics, and when a growing share of the country is living without savings, without stability, and without room to move, it becomes clear that the financial stress facing everyday Americans is no longer the exception. While millions of Americans struggle to keep up with the basics, the official narrative continues to describe an economy that is resilient, healthy, or even booming. Stock indexes hit new highs, corporate earnings appear strong, headlines highlight job growth and business confidence. But the experiences of everyday households tell a far different story, revealing one of the clearest economic collapse signs beneath the surface. The disconnect begins with how success is measured. Financial markets react positively when companies cut costs, automate tasks, or reduce headcount. Layoffs often send stock prices upward because investors see higher profit margins ahead. But what looks efficient on a balance sheet removes income from real families and drains spending power from the communities that depend on those jobs. Artificial intelligence and automation heighten this divide. Companies reduce their workforce, productivity rises, and the market responds with optimism. Yet for workers, these transitions mean fewer opportunities, stagnant wages, and increasing competition for jobs that once offered security. A strong market valuation does not guarantee a strong middle class. Even broad economic indicators can mask underlying fragility. Growth rates may appear solid, but they increasingly rely on consumer debt rather than rising incomes. Consumer spending remains high only because households are borrowing more, not earning more. It is a temporary illusion of strength, one that lasts only as long as credit remains available. On paper, the economy looks stable. In reality, many of the systems that support everyday life are weakening, and the farther these two versions of America drift apart, the more unstable the foundation becomes. Beneath national employment reports and headline job numbers, a quieter and more revealing shift is happening in local economies. The first signs often appear in the small service sectors. The handymen, inspectors, independent contractors, repair specialists, and local tradespeople whose work depends on steady household demand. When these workers begin losing business, it usually reflects a deeper tightening in the financial lives of ordinary families. Across the country, stories have emerged of handymen going days or even weeks without a single job, despite solid reputations and years of experience. It is not because the need for repairs has disappeared. It is because families are attempting to fix things themselves rather than pay for labor they can no longer afford. Home inspection companies report similar challenges, with slow seasons stretching longer than expected. Some have resorted to calling past clients for referrals, a sign of an industry struggling to stay active. Mortgage professionals describe a similar downturn. Loan officers in once booming markets say their workload is only a fraction of what it was a few years ago. High interest rates, unaffordable prices, and widespread uncertainty have stalled demand, leaving entire branches operating on minimal volume. These small cracks matter. When local service providers lose income, they reduce their own spending, amplifying the slowdown. Communities feel the strain as fewer dollars circulate. And because local jobs are some of the most sensitive to household financial pressure, their decline often signals what national data will not reveal until much later: a real economy growing weaker at the ground level. Individually, each financial pressure facing American households would be challenging. Rising utilities could be managed, higher rents could be endured, modest increases in groceries or insurance could be absorbed with careful budgeting. Even elevated debt levels might be manageable if incomes were growing proportionally. But the reality is that these pressures are not occurring one at a time, nor are they unfolding in isolation. Instead, they are converging, amplifying each other, and reshaping the foundation of everyday life. When utilities consume more of a paycheck, there is less available for rent. When rent rises, credit card balances climb. When credit card balances climb, minimum payments increase. As those payments rise, savings disappear. And without savings, any unexpected bill, a car repair, a medical expense, a school fee, a broken appliance, creates an immediate crisis. What begins as a single problem becomes a chain reaction. This convergence is why so many households feel financially exhausted. They are not struggling with one issue. They are struggling with all of them at once. And because each issue intensifies the others, families cannot regain their footing. The systems that once acted as stabilizers, wages, savings, affordable housing, predictable utilities, no longer provide the cushion they once did. Economists may debate the technical definition of recession, but households measure reality differently by the bills they can pay, the debts they accumulate, and the choices they are forced to make. And by those measures, the convergence of these crises is already reshaping what normal life in America looks like. Behind every statistic is a household facing decisions that grow harder each month. For many retirees, the rising cost of essentials has transformed what was meant to be a stable chapter of life into a constant financial puzzle. Fixed incomes that once covered housing, medication, utilities, and groceries now fall short, forcing difficult trade-offs. Some have begun skipping medical appointments or stretching prescriptions simply to stay within budget. Working families feel the strain just as sharply. Parents who once managed their bills with relative ease now find themselves recalculating every purchase, delaying car repairs, or downsizing daily routines. A growing number report receiving delinquency notices or warnings from utility providers, not because of irresponsible spending, but because their income can no longer cover the basics without slipping into debt. Younger households, too, are facing a different version of adulthood than the one they were promised. Many are postponing plans for home ownership, starting a family, or building savings, not due to lack of ambition, but because the financial threshold for stability keeps rising faster than they can keep up. Their vision of the future has narrowed into a month-to-month reality. These stories may not appear in official surveys, yet they illustrate what data alone cannot capture: the emotional weight of living in an economy where every choice feels constrained. The numbers explain the pressure, the lived experiences reveal its consequences, and together they show how deeply the current environment is reshaping the everyday lives of millions. In an environment where costs rise faster than paychecks and stability feels increasingly uncertain, many Americans are adjusting, not by choice, but by necessity. This shift is less about financial strategy and more about survival, a recalibration of how households manage risk, prioritize expenses, and prepare for volatility that has become the new norm. One of the most noticeable changes is the rise in self-reliance. Tasks once outsourced to service professionals, home repairs, maintenance work, basic inspections, are now being handled personally to avoid additional costs. Families are learning skills they never expected to need simply to reduce monthly expenses. Others have begun simplifying their lifestyles, cutting subscriptions, reducing discretionary purchases, or seeking alternative ways to stretch essential budgets. Savings, while harder to build, have taken on greater importance. Households that can manage even modest contributions to an emergency fund report feeling better equipped to handle unexpected expenses. Meanwhile, some Americans are turning toward assets perceived as more stable, not as speculative investments, but as a way to preserve purchasing power in an uncertain environment. Still, these adaptations come with limitations. Personal adjustments cannot fully counteract systemic pressures, nor can they replace the stability that comes from healthy wages, predictable housing costs, and manageable utilities. What they do provide, however, is a measure of resilience, enough to weather short-term disruptions while the broader economy struggles to find balance. As more people adopt this survival mindset, it becomes clear that the challenge is no longer just about affordability. It is about navigating a landscape where the rules of financial security are being rewritten in real time. When you look at everything together, a clear picture emerges. The U.S. cost of living crisis is not driven by a single factor, but by the combined weight of rising utilities, record household debt, and wages that can no longer keep up. These pressures have reshaped daily life, pushing more families into financial insecurity and revealing economic collapse signs long before they appear in official reports. Housing has become harder to afford, savings have become harder to build, and even the most essential bills have become harder to manage. This is the reality millions navigate each month, the true consequence of a U.S. cost of living crisis that continues to deepen. Which part of everyday life has changed the most for you? If this breakdown helped you see the full picture, consider subscribing so you can stay informed before the next financial shift arrives.